28, 29, that would be the time where you're going to see your value creation. So now's the time to buy. The next middle part of the game is going to be stabilize, get your house in order, make sure all your operations are fine, your renter base is solid, you're in the right markets, get your debt set up correctly.
All right, joining me now, Ken Macro. Ken, how you doing?
Great, Jeff. Great seeing you as always.
All right, listen. I've heard, and mainly because I'm watching you, but I've heard that there are properties that are on the marketplace for 80 cents on the dollar that are otherwise in really good shape. Now, anybody who's just common sense, that doesn't sound right. Properties are trading at that kind of distress level that otherwise seem to have good fundamentals. Seems like there's something wrong here. And I think the biggest problem that most people have when they hear something like that is that, okay, it's got to be just a one-off because, the stock market is soaring and everybody in the mainstream is so optimistic. How can we have a situation where it really seems like there's not just some distress in the marketplace, because I think people realize commercial real estate's been under pressure for a while, but doesn't it seem like maybe from your position, things are changing a little bit further where, before it was extend and pretend everything frozen, maybe starting to break free?
Well, okay. Yeah, there's three things that I think are really important that are happening across the board for pretty much all commercial real estate. The first thing is there's softness on the rent, right? Like, so when rates were really low, people started to build. And so we have this supply issue. So excess supply, more choices, rent softness. So that's one. Also, that turns into concessions and other things. And this is market to market. There are some markets that are doing really well, some markets that are really in trouble. The other one is what is least looked at are the operating expenses. So it's no surprise that utilities are up and property insurance has been all over the news and certainly property taxes. So when you have income going down or flat or negative, let's say, and expenses going up, that means your net operating income is suffering. So that would be one thing. And then, of course, what everybody's following mostly is interest rates. So when interest rates go up on floating debt, let's say, then the mortgage payment also goes up. And when a mortgage payment goes up, less cash flow. So you have all three of those things happening. Now, if you have fixed rate debt, you're actually pretty good. You can kind of weather the storm. However, we have loan maturities. So loans, when they mature, they're resetting. So I have several of those, dealt with those this year. We have two more coming up in the spring of 2027, where our rates were in the 4s. Today, we're definitely going to be in the 5s. So that means exact same property, same tenant, same income, same expenses. But now my mortgage payment's going to go up. So when the mortgage payment goes up, cash flow goes down on that exact same property. And so what you have is lenders that are sizing these assets based on lower income, higher expenses, and then this new mortgage payment. And all that it repriced really everybody. It's not a one-off issue. The whole market was repriced as a result of this.
Have you seen maybe more changes as maybe more people who are willing to sell and willing to, because I think that was the biggest defining feature after the initial crack up was like, hey, let's just hang in there for a year, maybe two, things turn around and it moves into the right direction. The numbers start to work a little bit better. The economy picks up and the rent side goes up. Because what you're saying is these property owners are being squeezed from both sides. They can't get the rents that they want at the same time their costs are going up. So the question I have, and I think the question a lot of people would ask is from your perspective, are you seeing people are starting to throw in the towel? Because it was, hey, let's just hang in there. Let's hang in there. And now they're saying we hung in there and it didn't really work out for us. So let's see what price we can get and get the hell out before the numbers get too bad in our direction.
Well, okay. So actually, it's an interesting question. Not necessarily. If you have one asset with floating rate debt, for sure you're throwing in the towel, right? Because there's no hope, right, on the future, on will rates go down? Will they ever be what I thought they were going to be? And how long is this going to last? And more than likely, they funded that asset for a while. In many situations, Jeff, as you know, like myself, we have a number of assets, 40, 50, 60 assets, let's say, where some of them are doing extremely well, and you might have a few that aren't, right? And so you're funding these, and if you have a loan maturity, of course, you're going to be in a situation where you're probably going to list that asset, and hopefully you have enough equity to return that back to people that are investors, and certainly enough to cover the debt. It's not really, if I have an asset and I don't have a loan maturity for 3 or 4 or 5 years, there's absolutely no way that I'm selling today. Because it's like, well, it's probably cash flowing because it has fixed rate debt on it. Yes, my expenses are definitely up. And yes, it's harder to get tenants, but that's the world I'm in. I'm used to managing that stuff. That's not new. And so, what I would be waiting for is for the market to firm up and, all of a sudden the supply to kind of dwindle down and then the demand to come back. And when demand comes back, then prices will go up. So if I have something that's got a few years left on it, absolutely positively not, I'm not going to sell it. If I have something that's 1 year out, maybe, or imminent today, maybe got floater, for sure, I'm looking at a variety of exits.
So basically what you're saying is it's a reset of fundamental expectations after things being way too high back in, 21 and 22. Now we're getting a little bit more realistic. As you said, property owners are becoming a little bit more attuned to the reality of the world that we're living in and trying to do the best that they can, which I think makes a whole lot of sense. So then the other wild card then would be the financing side. Getting any signs that the banks are balking a little bit, or are they just still willing to fund and maybe, to finance some bridge financing or fund some bridge financing? Is there tightening credit standards? Is there anything that suggests maybe there's some frictions building in the financing side of the equation?
Oh, for sure. So the tightening and all that already happened, right? Like this is not new information for lenders, debt funds, anything like that. They've been watching.
It's just new
this.
information for the public who've
Yeah,
been.
yeah. Well,
this is great. The stock market's booming.
Yeah, exactly. I know one of the things that we watch is what's the debt service coverage. And just to be simply discuss how that works, if your net operating income is $100,000 and your debt payment is $100,000, you're in trouble, right? I mean, it's 100% of your cash flow is servicing your debt. So that's called the debt service coverage, or that's what they watch. So obviously they want that at, let's say, 140, 150,000 of NOI with a $100,000 debt payment. That means you've got 30, 40, $50,000 of cash flow. So they watch this debt service coverage. So the debt service coverages have been on everybody's watch list for a long time. And that's really what people need to be looking at. And there's many, Jeff, where you have debt service coverage well under 1, like 0.6, 0.7, which means that the asset is actually worth 60, 70 cents, like we kind of started this, on the dollar. And so there's a variety of issues that happen when the mortgage payment is more than the NOI. So in other words, that money has to come from somewhere because the lender is going to want their payment. So typically that's being funded by someone. And if it's not, you're in default. But the one thing that's really interesting, Jeff, and this started happening a couple of years ago, is if you're supposed to be putting money into the project for regular maintenance, the painting and the parking lots and the landscape and the roofs and the interiors and all that kind of stuff. But when all your money is actually moving toward the mortgage payment and maybe even negative, that stops. And so what we're starting to see is this huge rise of deferred maintenance on assets because of that. And so what you have is some assets, and this is all predicated on primarily the debt. So you have assets where people just don't have the money to put back into them, so they're deteriorating right before your eyes. And then you have other assets that are just fine right next door because they have a 3.5% fixed rate mortgage that's not due for another 3 or 4 years, if that makes sense.
Yeah. So the question then is now a good time to start looking for bargains, or are you waiting a little bit for the cycle to continue to accumulate discounted properties? From the buyer's perspective, is it starting to be a buyer's market where, you can get some bargains out there that make sense, assuming you can cover the cost of deferred maintenance? Because that's going to come out of the price, right? I mean, you're not going to go out of pocket for that. So you're going to ask for a discount for, to be able to put the maintenance in, or, catch maintenance up where it goes. But from your perspective, is it look like maybe it's starting to becoming time to buy, or are we still too early for that, something like that?
It's 100% time to look, 100% time to get your dry powder together, for sure. Not necessarily the time to strike or act or buy, because a lot of that is predicated on the situation from the seller or the lender in this particular case. For examples, if you have a brand new Class A building, you personally, let's say you built this beautiful building at 200 units at $400,000 a unit, and it's and that's what your costs were. That property today is probably worth $250, $275 a unit. So you're not in a position to sell, and anybody knows that that property is going to be priced significantly below what it costs to build. And so the equity's gone for sure. And you might be actually negotiating with the debt. So if I'm dealing with you, you're obviously trying to sell and you're trying to cover your debt. And you're maybe even trying to get a little bit of equity out of it, but the market bears what the market bears. Now, let me reverse that. There are lots of situations where a lender has actually taken back an asset and it's sitting on their books. And so the person who used to own it is long gone. The equity's long gone. And now the lender is actually trying to figure out what to do with that asset. And again, the market again is pricing it based on the market is. And so how does it price itself? What's the occupancy? What's the expenses? What is the interest rate? And in a lot of cases, Jeff, they're not even financeable, because obviously a lender is going to finance something that's stable. And so you've got all these scenarios. And so when you start getting into bridge or you start getting into short-term debt, it's priced higher. So which actually makes it worse for the project, because when you're buying something distressed, you don't want really expensive debt, like hard money almost. So it's this kind of catch-22 that everybody's in. The interesting thing is that the lenders are taking big haircuts. And so I'll give you an example. We have an investment committee that we meet with every week. In the last month, we had 2 assets, and we probably looked at 6 or 8 assets, but there's 2 of them specifically. One, we made an offer at $8,000 a unit. Now, let me just wrap your head around that. $8,000 a unit is below the land replacement cost. Now, here's the thing, 100% vacant next to a military base, and it's in Texas. And so the question would be, why would I ever buy anything like this, right? Well, because I know, because I've done it, I could spend maybe $20,000 to $30,000 per unit to fix that thing. It might take me 2 years, and my entire basis is going to be, let's just say, around $30,000 a unit. And so then I solve to the end, and then I figure out, is it worth it or not, right? So what would the market be today with today's rates, today's expenses, today's rents? My basis was $30,000 to $35,000 a door. And the answer on that particular one is it's around 60. So it's worth a short term. Now, it's not financeable. Have to buy it all cash, have to finance all the improvements.
You would have to be out of pocket for basically everything?
Correct. Yeah, because who's going to finance a 100% vacant deal that's in full distress? Now, there are ways to do that, and it's going to be expensive, but so that's part of what we're looking at. But the upside, of course, is when we stabilize that, if we get it, when we acquire it, we know that we're going to be way in the money. And, there's some variables there that we could be off on even, right? And maybe it's $40,000 a door, but we're going to be fine on that asset when it's fully fixed and fully stable. The interesting thing and the irony is it's lender owned. It was purchased 4 years ago at $90,000 a door. Think of the people before us, right? The equity's gone. The lender is certainly taking a massive haircut, and who knows where all that goes. But we get this opportunity to fix it. And so those deals, they're not everywhere, but they're out there. You're dealing directly with the lender. And there's massive risk on our part, of course, because interest rates could keep going up. We might completely mess up the renovation. I have done this for 30 years, so we have a pretty good understanding of how to pull this off. I've certainly bought a bunch of stuff like this in 2008 when what's now called the GFC was happening. So I'm used to this. The question is what's your basis? What are you buying it for? What's it going to cost to fix it? How much money are you going to spend to get it to that point, and add all that up? And that's your new basis. And that's your full investment. And then what's that in today's market? And of course, if interest rates keep going up, then it makes it more of a problem. If they stay flat, it's, all things work. If the interest rates go down, that thing's going to be worth even more. And that's ultimately another risk.
Well, that is a lesson, right? The lifelong lesson in any kind of investment, but especially real estate, is to be the guy on the other side picking up the bargains. You can't be the one who's panicking, being forced to sell. You got to be the one who has the resources and everything ready for the other side of it, right? That's what keeps coming up to my mind. You said the lender owns the property, and so they're taking a huge haircut. Are there a lot more of those opportunities showing up, or are these just kind of like, one-offs that are here and there? Are you seeing that as more common, or is it just lenders trying to clean up their balance sheets while they can?
Yes, and yes. I would say, it's interesting. I think there are certainly one-offs. We're seeing them though, in different cities, different lenders. And the process is interesting, right? Because the lender's been involved for a long time. The lenders obviously at first trying to meet and negotiate with the borrower, perhaps. And then there's that process, and that could take time. And then, somehow this thing got to basically 100% vacant. Who knows why or how that, they obviously messed that up completely, because, you should not be 100% vacant anywhere. But I actually found 2 properties like this, extreme, in 2 different cities. And so they are one-offs at this point. But every lender, of course, just like, let's say you were a lender, you have to look at your situation personally. What do I want to do here? Do I exit? Do I sell it? Do I take my loss? Do I not? Obviously, a board probably and shareholders. You have to get approvals on all this stuff. So it's not like a light switch, right? Sometimes it's a death of 1,000 cuts, and then you're just sitting there fully defeated. Sometimes you have very sophisticated lenders, banks, debt funds that are like, yep, let's just take the cut and move on. We'll figure it out, move it the other way, and the process can be faster. In all cases, there's usually a broker in the middle somewhere trying to figure out, trying to get the listing for sure, but also negotiating with both sides. But what you say, beautifully, the market basically determines the price. We try to believe that we do, but at the end of the day, the market.
You can try, but it doesn't work.
No, the market basically does all the work for you, and then everybody just fights against the market forces. So this is where we are today.
Yeah, and by the way, for people who don't know, you've got Limitless coming up next week. Just popped in my head because I got to make sure I get my ticket to Arizona. Limitless, by the way, huge conference. I've been there a couple times. I was there last year. Going again next month. If you haven't been to Limitless, I gotta recommend you go there. Not just because of the speakers who are always terrific, but really what really sets it apart is the audience. I really like just wandering around with talking to people from all different walks of life and all different, skill levels and everything else. If you're looking for an opportunity for, to talk to people like yourself or talk to people who are really interested in the same things and who are very good people you want to know and make friends with, I highly recommend you check out Limitless. There's a website for that and everything?
Yeah, limitlessexpo.com. Thanks, Jeff. I appreciate that. I can't wait to hear your talk. I know we were talking the other day and you said, I'm not quite sure what I'm going to say yet because things are so, moving so fast, which is actually, it's interesting. Each year we try to cater to what's on people's minds. And I think this year there's a tremendous amount of uncertainty, obviously around, the energy prices and the interest rates and the prices of real estate for sure. But also on the other side of it, AI, unemployment. There's all these things that we try to pack in there because I don't have all the answers for sure. And I go to listen as well. And so we're constantly trying to find the right people that are actually experts out there. No selling from stage, pure education. And this is our 5th year. And it's gone beyond what I thought it would be, but it's obviously one of the best times for us every single year.
Yeah, and that's in Arizona, just so everybody knows it's in Arizona. I've actually never been to Arizona more than just an airport. So I'm looking forward just to visiting Arizona. I think that'll be cool too. Plus the setting and the conference and everything else. So highly recommend it to anybody out there who hasn't been to Limitless, or if you have been, and I'm just reminding you, make sure you get your ticket because it is definitely worth your time and effort. And like you said, Ken, we got a lot to talk about. There's a lot to discuss here. We got the energy shock, we got interest rates, AI, which is on everybody's mind, probably the stock market a little bit though. That's one thing I do like about the Limitless crowd is it's less about equities and more about, deeper commercial matters and things like that. So let's talk about that. Let's talk about interest rates a bit here because we got the CPI report for June, which I think shocked some people in how weak it was. I'm not sure the market was all that shocked because you look at Treasury inflation protection securities who have been saying there's no inflation risk.
Yeah.
Yet the marketplace is pricing higher rates because the market's looking at the Fed and Kevin Warsh, who are focused on oil prices and not the rest of the economy. And so you understand where people are thinking, all right, where are interest rates really going to go? Are oil prices going to stay high? And is that going to lead to a regime where rates are going to go up? And so from your perspective, Ken, in real estate, I imagine this is something that people are just laser focused on.
They are. It's interesting because I saw that come out this morning and I saw the CPI drop. Core inflation, however, didn't change all that much, as you know. It does matter. The 10-year and the 2-year matter to us a lot, right? And we did not see dramatic movements in those yet. Obviously, there were some, but they, those matter. Like this all matters a lot. What's interesting to me is I actually don't know why the energy costs went down that much. I mean, I saw the price. It doesn't look to me like there's anything meaningful that really happened in the last 30 to 60 days, like around any of this. Like the straits are still a mess and the reserves are still a mess. And, and so I'm like, well, why is all this happening? There's somebody behind the curtain there that's pushing this down. And it's very interesting.
Well, if you look at just start with the CPI numbers themselves. What they said is that, what the Fed keeps focusing on is energy prices go up. And because energy, you can't really get away from it, is energy prices go higher, then say you're a service provider and your energy costs go up, your input costs go up, then you got to raise your prices providing whatever service to the public in order to get that money back. And so the Fed, it's an institution staffed with economists. So they're always thinking ceteris paribus. So all else being equal, if energy costs go up, then other prices should go up alongside them because it only makes sense. But we live in a real world where all else is never equal. Yeah. So what the CPI report reported was essentially that energy costs went up and then they came back down, but other costs didn't go up. Other costs went down. I mean, this is something that Walmart was talking about just recently. Walmart said, we would love to raise prices on our customers, but we know what happens when we do. We raise our prices, they disappear. So we're actually going to cut prices. And so what the CPI report really said was the economy is weak and service providers in particular had to cut prices in order to maintain volume, even though they want to raise prices, which leads to all sorts of other consequences that are very relevant for your neck of the woods, because that means that incomes and jobs are only going to be under further pressure, which means rents are going to be under further pressure. And so what emerges from the CPI report as well as the marketplace is more of the traditional recession case that goes along with an energy shock. Higher energy prices, you set the Federal Reserve and mainstream economics aside. Common sense, if you raise energy prices for non-economic reasons, if the economy can't handle it, the response in the economy is to pull back. Everybody ends up pulling back, incomes pull back, unemployment goes up. And so what the CPI report essentially, and I don't want to say confirmed, but it certainly feels like it was moving in that direction, was the demand destruction that goes along with an energy shock case. And I think that's one reason why people were shocked by it, because they keep hearing how the economy is resilient when you know from your business that that's not really the case. When we say the economy is not resilient, but that doesn't mean, it's falling off a cliff. It's not early 2009 all over again. It just means that regular people are struggling. They really can't afford higher gasoline prices, so they're cutting back in other areas. They're not pulling back. They're not, it's not an absolute crash or catastrophe, but it's enough at the margins that it shows up in the CPI report, and it makes business that much more difficult because you're trying to struggle bringing in revenue when your customers are hurting at the same time you're hurting because your gas bill and your energy bill is going up. And so it just adds more and more pain. I think one of the things that the marketplace, or not really the marketplace, but one of the things that the commentary keeps looking for is the breaking point. When are we going to get to the breaking point where everything does fall off a cliff? And I'm not sure we're going to. I think it's, we've been in this situation for a couple of years where the pressure just keeps building and building and building. It makes people miserable, but it doesn't necessarily lead to something like a massive, full-on, full-blown contraction that just wows everybody's, knocks everybody's socks off. To me, the CPI was like, hey, we've got demand destruction. We've got more pressure on consumers and businesses. And it's not going to lead to inflation. It's going to lead to the opposite.
Yeah, that's a really excellent point. From my standpoint, I'm obviously a multifamily guy, and we have 10,000 apartments, and we're heavy on the landlord rental side of the equation versus ownership. So back in '08, we lost a lot of people to ownership. '06, '07, '08, when the president was rolling out these, everybody needs to be a home owner policy, which is totally fine, but that took people out of the rental side. Now we're seeing it move the other direction. And to your point, one of the things that we didn't have back then was the cost, not the mortgage, the cost to own a home, just the cost. I'm talking about the maintenance, the insurance, and
insurance, ridiculous insurance,
just all of those things. Just to own the home. Let's don't even talk about interest rates for a minute. Just like, let's say you have no mortgage, there's a cost there. They don't have that on the rental side of the equation, which is really interesting. And so right now, of course, because there's so much inventory, the renter has the upper hand. There's concessions in the market, occupancies are down. And so there's, I know in part of the CPI is that OER, the owners will let a rent, which is kind of a joke. But regardless, it is a piece, right? And so for sure, you're not seeing any rent growth in that CPI at the moment. Now that could change in time, but when we start to see a sway of people, great if the mortgage payment goes down, but what about the ownership piece? That's also going up. That's just pushing more people to the renter side of the equation, which is going to eventually push again. And it's going to, we're already seeing absorption pretty high. People are not buying like they were. They're not financing like they were. They're not moving around like they were. That's all true. And so people are electing to stay in apartments or rentals longer. That's not necessarily good. Obviously, even I have 2 kids. You've met them both. I want them to be able to, rent, save some cash, buy an affordable home. Those days are tough right now, extremely tough. That down payment is without out of reach for many, many people. So all that means is that more pressure is going to stay on the rental side of the equation for a while. And so that to me is what I look at. That's one more reason why we could head more into, a renter nation if we can't get that, not even talking about interest rates at the moment.
Yeah, that was one thing I was going to ask you here. Is that one of the reasons why you said, earlier on in the video here, you talked about you want to be looking for properties? Is that kind of a structural tailwind that you expect to carry forward, that eventually people who are not buying houses or maybe even selling out of the house that they own and, they got to live somewhere, they start maybe renting. So you have, a structural shift out of single family housing and into multifamily, which you're right. From a macroeconomic or an over high level perspective, this is not a good. And we actually want the opposite. We want people owning homes because it makes them better people. They're happier. Yep. They're creating equity for themselves, which is usually their biggest asset. So for an actual healthy economy and society, we want people going the other direction. However, recognizing that, from an individual perspective, there's really not much you can do about it except, hate to say it because it sounds very cold, but to take advantage of what's taking place from somebody who's got investable funds, there's an opportunity here. So that's the question is this one of the things that you're looking at as a reason to begin looking in the property sector and say, look, as long as this continues, the pressure continues to build on especially households, they're not going to have much choice. They're not going to be able to afford a rent. I know the National Association of this is a statistic I throw around all the time. The NAR last year in their annual report said the median first-time homebuyer age was 40. Yeah. Which means people are going to be renting for a long period of time. So is that something you're factoring in as you're looking for properties, so thinking that's a significant tailwind?
Yes. So there's a few things. The first thing is price and basis, right? You want to make sure that you have a tremendous amount of room there. So we have seen a repricing. Cap rates are up.
Which we said before is in your favor, right? Because
Correct.
The market is repricing from a high to a low.
Yes.
So I can see where you're coming from. There's a lot of factors that they're not there yet, but they're starting to line up in just the right way.
Correct. That's right. Yeah. So first thing is price. Then of course is will we have a lot of pressure of our renters moving to single family, right? That's a big one because again, that's just, I'm not going to change history. That is what people do. They oftentimes rent and then save and then buy a home. And, during home building times, they prey on the apartment builders and the renters, and they say, why rent when you can buy? And that cycle will repeat itself at some point. But what we have, it's very different. This cycle that was not in the GFC is we had 4, 5, 6 million homes on the MLS, and we had a massive repricing of single family. So single family came down in price, which then started to compete with multi again, and then it just cycle repeated itself. And so,
that's one of the things about the current cycle. It looks bad, but prices have been relatively stable. So,
correct.
I mean, that's in your, so what you're saying is in order for the cycle or the structural change to shift again, you would need to see either home prices come way down to make it economical for renters to move back to owners, which that wouldn't be a good thing either.
Right. No, that's right.
But that's really kind of the only, either incomes really do have to rise precipitously in a sustained fashion, or home prices really have to come down. And neither of those things seem to be, at least imminent or maybe even likely.
Right. And then add that inflationary operating cost, to that as well. So you've got home prices that are relatively stable, and they're certainly not going to the spot where they were when you and I both went through the GFC. I personally went through that. So the home prices are still somewhere just bumping around 400, I think. And so even if rates come down from 7, 6 to 5 to 4 or whatever, I still think you're going to have these affordability issues.
No question, because it's not, you're right. It's not just it's not even really the interest rate. It's a whole bunch of other factors. Do you have, is there any way to, or maybe you've already thought this through, how long a cycle it might be before you get to that? Or is that just, hey, look, this is a structural change that we can take advantage of and just ride it as long as we possibly can, and hope that these, these positive factors that are lining up for multifamily continue to line up, and they spit off these bargains every once in a while. You jump on them, make a lot of money there, and hope that they kind of proliferate.
I put things in baseball terms. And so I think that I always tell everybody we're in the first few innings right now where, you don't know where this is headed. We do think we're hedged on the single family piece, which we already discussed. We don't think we'll have any threat from there. The issue the market currently has is we have an oversupply or a hangover, very low interest rate, produced a tremendous amount of supply that hit a lot of it in 25. We had a 50-year high of supply in multifamily in 25. That's still working its way through the, as George would say, the pig through the python, right? So
it was a huge fat pig too.
Yes, it was. And so that's actually creating great. So, from an operator standpoint, I have concessions, I have high expenses, I have these high rates. My values are down. Not great if you own, but if you're trying to buy, great time to buy with kind of the headwinds. So I think we're in the first few innings. Now's the time to put together your team, put together your capital, put together what markets you're going to buy in, because obviously they're all very, very, very different. And the lenders, this is a very different time. This is not like we just went through. The lenders are asking questions like, if I give you 100% vacant asset, can you pull this off? Can you stabilize it? Because there's a million things that can go wrong. And so you can't just raise capital, right? And you can't just assemble a team randomly and say, oh, yeah. So there's going to be a lot at stake for this next cycle. And I think the experienced people that have been through this before are the ones that are going to get some of these deals, because the lenders, the last thing they want are these things back. Right. So you've got this really interesting time where I think the next 4 or 5 innings are going to be certainly 27 and early 28. And then the interesting thing, Jeff, is that higher interest rates also shunted supply. So when rates went up, like if I have a piece of land and I was going to build it at 4% or 5%, and now they're 8 or 9, I'm like, I'm going to pause. It's still a vacant piece of land that I own, but I might not build something on it, right? So if you take a look at the future supply, it dropped off a cliff in 24 and 25. So you've got the supply drop off, this absorption happening, and that is going to cross. The line will cross in late 27, potentially early 28. And then at that point, you're going to see significant rent growth again, because as always, everybody's way behind this. And when you start to see rent growth, then you're going to start to see this irrational exuberance and all this money chasing it. And it'll push prices up again. So that to me would be, innings, call it 7, 8, 9, would be 28, 29. That would be the time to where you're going to see your value creation. So now's the time to buy. The next middle part of the game is going to be, stabilize, get your house in order, make sure all your operations are fine. Your renter base is solid. You're in the right markets, get your debt set up correctly, and then position yourself for when you start to see that rent growth, and maybe experience it for a year or two. Who cares how long it goes? But then start to exit positions, and that's essentially what our plan is.
So there's the setup, and it sounds like you got a pretty good window, but like you're saying, it's not as long a window as you think, because there's a lot of homework to be done, a lot of stuff to get in order before you get there. So then everything starts to ramp up. You're right. Everybody gets exuberant again. Then prices start to really rise, especially in the early stages of the upturn, which is where you really make your money because everybody's still euphoric. And so you got a lot of things to do before you can even get to that point, which means, so I guess it really brings us back to where we started. That's why you need to be looking right now, getting your ducks in a row, because the time runs out much more quickly than you think.
Yeah. And not all markets are identical. So I'll just give you like 2 things that could not be further from different. Well, one is in downtown Phoenix, which is an area that, in my opinion, I would never buy, but a lot of out-of-state builders. I'm talking about multifamily specifically. They built a lot of property down there. Gorgeous, garage parking, elevator, rooftop pools, all that stuff. It's not uncommon for you to see 2, 3, even at one time they had 4 months free on a 12-month lease, which means that way more supply for the people. So great if you're a renter, right? But not great if you own it. Not great if you lending on it. Not great if you invested in it. But you can literally go 5, 6 miles away to Tempe, Arizona, which is where Arizona State is. It's a tale of two cities, man. Like highly occupied, not a lot of excess land. Wasn't overbuilt. The market's still growing. This is why market selection is so important, because, we looked at downtown Phoenix and we looked at some areas like West Phoenix or the West Valley. And we're, of course, in Dallas and we're in Vegas and we're in Salt Lake City. And right now I'm in Idaho. And there's other markets that we're looking at. But the point is, each one has a very different recovery cycle based on supply and based on the amount of people that are coming. So you got to be very, very careful. And that is really important as you start to head out into that inning 7, 8, 9, because, a market like downtown Phoenix, that could push out significantly longer, right? And then, of course, there's a whole bunch of economics that don't always add up when you're holding something that long.
Ken, let me ask you one more question before we wrap up here. Then, are you seeing, since you're saying there's such a regional or even interregional differences, is there places that you look at right now and say this is where things are getting really bad? I mean, you always hear about the South, because the South tends to be high beta and high volatility and variability. Is there places that you're looking at right now that suggest, hey, this is where things are getting really bad really quickly, and this is maybe where you want to look for the bargains? And then there are other places that are doing really well that you don't really want to go waste your time on?
Sure. Well, I'll take a shot at the urban core and whatever. Call it Seattle, call it Portland, call it San Francisco, call it where people don't want to be right now. Right now, oddly enough, there are pockets where, like, even New York had high rent growth. Oddly enough, because they're not necessarily moving out of the state, but they're blowing up little areas. So that's the first thing I want to take a shot at, because that's a real issue from a safety standpoint, from the politics and what's going on with all that is important. The overbuilt ones, certainly Austin, Texas is a poster child for really fairly in trouble. The single family home prices dropping, multifamily dropping. Then you go over to Nashville, another incredible story. Certainly there's pockets in and around some areas of Texas. Florida, very different reasons, but a lot of people move there, a lot of building, actually more of an Airbnb bust there. So there's little things going on. The Midwest has actually been really pretty stable, pretty neutral. So yes, market selection is everything. And again, they're not necessarily like, I personally love Nashville and Austin long term, but you've got so much supply there, and like Nashville's not that big of a town when you're looking at a metro, so you start to look at what's the in-migration, how many people are moving there, is it affordable still, and all of the things that affect why somebody would move somewhere. So all that's really important. So for us, we look at where are people going and what's the supply and how long will it take for this to correct.
So basically, who made the biggest mistakes and how can we help them correct it?
Yeah, exactly right.
I mean, that's what makes a free market, right? Like I said before, if you're on the good side of it, you're part of the correction mechanism, which means you get to pick up tremendous opportunities from other people making mistakes, which is, you think about it, that's one hell of a business to be in, right?
Yeah, right now. And, to your point, the banks, they're not set up to own real estate, as you know.
No, they tried that, 20 years ago. They don't want to do that again.
Yeah. So we're getting into that situation again where you've got people that don't really understand it. And so they need seasoned, experienced operators that can go in and say, listen, we're not trying to steal anything. We're just trying to buy it for what the market is bearing today. And then, what's really happening is that they're transferring their risk to us. So we're buying their risk and they've already taken a haircut, but there's still risk.
Well, you have the clean balance sheet. That's why you can take the risk.
Yeah.
Yes. Ken, I really appreciate your time. By the way, again, everybody check out Limitless. I cannot recommend it enough. It's one of the best, and if not the best conference that is out there. Arizona, you can't go wrong with that next month. Ken, really appreciate your time. We'll see you again pretty soon.
Jeff, as always, thanks for being on. I appreciate it.
Awesome. Thanks.